Looking at the top-line numbers, the United States economy appears to be running hot. Gross domestic product continues to grow at a robust 4%. This chart reveals a contradiction. On the left, steady 4% macro growth. On the right, reality diverges. In January alone, corporations executed 108,000 layoffs. Giants like Amazon and UPS cut tens of thousands, while this bottom line shows real wages remain completely stagnant. This tension between rising output and contracting employment is a permanent structural divergence in the modern financial system. When the data conflicts this sharply, standard macroeconomic models, which assume broad-based, uniform growth, are failing to measure reality. What we are witnessing is a K-shaped economy. In a K-shaped system, different sectors move in opposite directions simultaneously, with one group climbing as the other consistently declines. To understand why this happens, we must look to Austrian business cycle theory. Formulated nearly a century ago by economist Ludwig von Mises, this framework explains how monetary policy distorts economic outcomes. The core of the theory is that when a central bank expands the money supply and artificially suppresses interest rates, that new liquidity does not lift all sectors equally. Instead, this policy misallocates capital. It funnels wealth into asset-heavy industries while actively hollowing out the traditional labor-intensive industrial base. This K-shaped divergence is a predictable outcome of sustained artificial interest rate suppression. To see what forces the central bank to keep rates low, we must look at the root condition of the global financial system. The United States government sits on $38 trillion in national debt. Decades ago, this debt was a manageable 30% of the nation's total economic output. This chart tracks that trajectory. We see the curve steepen until government debt crosses 120% of gross domestic product. Historically, the 100% mark is a point of systemic no return. The burden has decisively breached this critical line. The true danger of this accumulation lies in the compounding cost of the mandatory interest payments required to service that debt. Look at the secondary curve. Interest payments are now projected to eclipse all U.S. defense and discretionary spending in the near future. The U.S. government is trapped by its own debt servicing costs, removing its ability to naturally absorb economic shocks. To prevent a sovereign default, the central bank is forced to intervene directly in the bond markets. The only countermeasure available to stop this debt spiral is a mechanism called yield curve control. Yield curve control is the artificial capping of government bond yields. The central bank commits to buying up 20- and 30-year treasuries to ensure their interest rates do not rise above a targeted limit. To maintain those artificial bond prices, the central bank must purchase the debt. To do that, they must flood the system with printed fiat currency. Saving the sovereign bond market from default creates a systemic devaluation of the underlying currency. This brings us back to the core mechanism of Austrian business cycle theory. We need to track exactly where this newly printed money goes. This model visualizes capital from the central bank. Liquidity doesn't spread evenly, but splits into two unequal channels. The high-volume flow moves into entities leveraging debt for speculative projects, filling nodes tied to capital-intensive sectors like artificial intelligence. These advanced technology sectors disproportionately benefit from artificially suppressed interest rates. They can borrow cheaply to finance massive structural buildouts. This liquidity results in the inflation of asset prices. Stock portfolios skyrocket, real estate climbs, and equity valuations soar, rewarding the wealthy owners positioned in these channels. Contrast that top-heavy boom with the secondary flow. The capital reaching the rest of the physical economy is severely constricted, trickling into nodes labeled labor-intensive manufacturing and construction. Traditional industries are actively starved of this capital investment, even as their everyday operational costs continue to rise. The working class absorbs the secondary effect. They face general price inflation without receiving corresponding wage growth from their starved industries. This malinvestment starvation effect is the root structural cause of the mass layoffs we see in retail and logistics. The K-shaped divergence is the malinvestment engine of fiat expansion. It drives wealth upward while hollowing out the labor force. Global macroeconomic actors are reacting to this forced cycle of currency devaluation in real time. Central banks around the world are executing a paradigm shift, turning their reserve assets away from United States Treasury bonds. Today, gold comprises over 50% of total global central bank reserve assets. Precious metals act as barometers for fiat stress because of a specific microeconomic concept: dual inelasticity. This chart graphs the reality of dual inelasticity. Inelasticity means quantities do not change easily in response to price. The physical supply of metals is constrained by mining limits, resulting in a steep supply curve, while the baseline demand remains rigidly vertical. When a massive new demand vector enters this rigid market, like central banks engaging in capital flight, the demand curve shifts outward. Because the supply cannot easily expand, the result is a severe vertical spike along the price axis. This aggressive upward price action is particularly violent and structurally volatile in smaller, tighter commodity markets, just like silver. Rising prices in precious metals are the necessary thermodynamic relief valve for a system that cannot physically print more hard assets. This diagram pulls back to view the entire macroeconomic landscape, linking 4 interconnected nodes. The cycle begins. The sovereign debt spiral forces rate suppression, driving capital malinvestment. This ultimately forces institutional capital into hard assets, building massive pressure. The paradox of mass layoffs occurring amidst positive GDP growth is the direct consequence of this prolonged misallocation. No single central bank can independently reverse this trend. Attempting to do so would trigger a catastrophic sovereign bond default shockwave. Current global market conditions are behaving exactly as Ludwig von Mises' century-old framework predicted they would. Modern financial models often dismiss gold and silver as speculative trades or historical relics. These markets are pure thermodynamic indicators. They physically measure the accumulating stress and the underlying weakness of the global fiat system. The structure of the system devalues the underlying currency to service its exponential sovereign debt burden. Rising commodity prices reflect the physical market pricing in the eroding purchasing power of the fiat currency beneath it.